Hi, my name is Jonathan Ruiz.
Taylor Shetler.
Danny Gonzalez.
We're going to be presenting on management of translation exposure. So the problem the company is facing is that the company has expanded globally within the last 10 years and into many markets. As the company expands into more international markets though, the risk of translation exposure becomes greater. This is because the company is dealing with various currencies at the same time, and the currencies are always changing. The balance sheets are not taking into account translation exposure, and thus the company could be losing up to and more than 500 million or more in assets and liabilities. So some of the translation methods or also known translation exposure is also known as accounting exposure. So for the methods to deal with foreign currency translation are the current and non-current method. This is the assets and liabilities are translated based on their maturity. Current assets and liabilities are converted at the current exchange rate. Non-current assets and liabilities are exchanged at the historical rate. Also under the current and non-current method, a foreign subsidiary with current assets in excess of current liabilities will cause translation gain if the local currency appreciates and vice versa. Monetary and non-monetary method. All monetary balance sheet accounts of a foreign subsidiary are translated at current exchange rate, and non-monetary balance sheets are translated at historical exchange rate. This sounds the same, but the difference is that monetary and non-monetary method takes respects to accounts such as inventory, long-term receivables, and long-term debt. This method classifies accounts on the basis of similarity of attributes rather than similarity of maturities, which is the emphasis of current and non-current method. In temporal method, monetary accounts are translated at current exchange rate, and other accounts are translated at the exchange rate of the date that items were placed on the books. Under this method, most income statement items are translated at the average exchange rate of the period. And current rate method is all balance sheet accounts are translated at the current exchange rate. This is the most simplest of all translation methods to apply.
The FASB 8 came effective January 1st, 1976. Its objective was to measure in dollars an enterprise's assets, liabilities, revenues, or expenses that denominated in a foreign currency. It is essentially the temporal method, which requires taking foreign exchange gains or losses through the income statements. It ran into acceptance problems early on through the accounting profession and MNCs. One of the problems was that reporting earnings could and did fluctuate substantially from year to year, which was irritating to the corporate executives. The second problem was that the multinational corporations did not like translating inventory at historical rates, which was required if the firm carried the inventory at historical values, as most did. So it felt that it would be much simpler to translate it at the current rate. Given the controversy surrounding the FASB 8, the Financial International Accounting Standards Board created the FASB 52 with two stated objectives, the first being to provide information that is generally compatible with expected economic effects of a rate change on an enterprise's cash flow and equity, and the second to reflect in consolidated statements the financial results and relationships of the individual consolidated entities as measured in their functional currencies. So the FASB 52 was created in December 15th, 1982. It's a two-stage process. The first, determining which currency the foreign entity keeps its books. If the local currency in which the foreign entity keeps its books is not functional currency, remeasurement into the functional currency is required. Remeasurement is intended to produce the same results as the entity's book had been, as if they had been maintained in the functional currency. They use the temporal method to translate the remeasurement. The second part of this process is when the foreign entity's functional currency is not the same as the parent's currency. The foreign entity's books are then translated from the functional currency into reported currency using the current rate method. The translation is not required if the foreign entity's functional currency is the requires entities' financial statements to be remeasured from the local currency using temporal translation method. That's only necessary in high inflation economies, and that is described as one that has accumulated inflation of approximately 100% or more over a 3-year period. The purpose of this requirement is to prevent large important balance sheet accounts carried at historic values from having insignificant values once translated into reporting currency at the current rate.
Right. So I'll be talking about the International Accounting Standards. So the International Accounting Standards is used to provide a common accounting language in the business world. It started first within January 2005, where all of the companies in the European Union have started to use the International Accounting Standards. The IAS was influenced by the International Accounting Standards Committee, which then was able to submit a report of the IFRS, which stands for the International Financial Reporting Standards. This report gave us the IAS 21, which is the standard for handling foreign exchange translations. And this could be the resemblance of the monetary and non-monetary translation method. Then in 2009, the International Accounting Standards Board and the Financial Accounting Standards Board issued a statement to a previous memorandum to achieve substantial convergence of accounting standards by 2011. So right now it is currently behind, but most countries will follow the common standard for foreign exchange currency translation. Now I'm going to be getting into the case. So for the case, we're giving a company named Centralia Corporation, which is a U.S. patent, which is located in Mexico and Spain. Because we are located in different areas, we're going to be working with the U.S. dollar, the Mexican peso, and the European euro. In order to determine the effect of the exchange rate that we'll have on a consolidated balance sheet, we can use the translation exposure report, which is, for example, on Exhibit 10.6. This report shows the amount of foreign exchange exposure that exists for each foreign currency in which the C has exposure to. A positive net exposure means more exposed assets than liabilities, and then vice versa for a negative net exposure. So the exchange rate of an exposure currency depreciates against the reporting currency. Exposed assets fall by greater amounts than the exposed liabilities if positive net exposure. When an exposure currency appreciates against the reporting currency, exposed assets increase in translated value by a smaller amount than exposed liabilities if there is a negative net exposure. Consolidating these processes will not result in a balance sheet that balances after the exchange rate change. Now, as we can see in 10.7, it shows the consolidation process in consolidated balance sheets for Centralia Corporation and its two foreign affiliates after the depreciation of the euro. You can see in the beginning at the 10.5 example, it says in all of their local currencies, from the euro, the dollar, and the dollar, and the peso, and then it shows the differences after the net exchange. As you can see, there was a depreciation of the euro, so there was a negative net income for the Spanish officials. So to conclude with the case, I will end with what Taylor said about the FASB 52, which handles the effect of rate changes as an adjustment to equity rather than as an adjustment to net income, because exchange rate changes has an indirect effect of a net investment that may be realized upon sale or liquidation. But prior to the sale or liquidation, the effect is so uncertain and remote as to require that translation adjustments arising currently should not be reported as part of operating results.
Alright, and then this slide, it's going to be about management of translation exposure. Some of the items that are a source of translation exposure is also a source of transaction exposure. And two methods that are mentioned in the chapter that deal with transaction exposure are balance sheet hedging and derivative hedging. So balance sheet hedging pretty much eliminates the mismatch of net assets and liabilities denominated in the same currency. Derivatives hedging, there are various types of derivatives, but the one that is mentioned within the chapter is using a future contract to hedge. A future contract is an agreement between two companies for the sale of an asset at an agreed upon price. Translation exposure does not have an immediate direct effect on operating cash flows, and it is also not possible to get rid of both translation and transaction exposure completely at the same time. And when you're dealing if you're dealing with derivative hedging, the thing is, it doesn't fully deal with, but it attempts to control transaction exposure because it involves speculation about the foreign exchange changes. And so our solution application to the is that based off the information just mentioned, we would advise GTC to use current rate method, temporal method, derivative hedging, or balance sheet hedging. The company should do a proper analysis of the balance sheet to discover any possible translation exposure, and then apply one of the methods that best suits the situation. By using one of the methods, the company could prevent losses that could possibly add up to 500 million or more